Yes, we can hear you.
Yeah. So let me set up the expectations right for the today's session. See, today's session would be actually, see, mutual funds is a very vast subject in its whole. So I would love to cover it into two-part session. So today, what we would be looking into it, uh, the basics of the mutual funds, that what actually mutual fund is, and what are the various category of mutual funds, what is the risk category of various type of mutual fund schemes, and what is the expected returns, what should be the time horizon, like based on your time horizon, which kind of mutual funds you should look for. And then the next session, or maybe sometime later, we can conduct a session whereon specifically with regard to like how to pick up a proper equity mutual fund or a proper debt fund. Okay. So yeah, so hi, I'm Rajesh Jain, and just brief about me. So basically, I've started my career as an advocate. So my academic qualification is BCom, LLB, FCS, that is Company Secretaryship, and I've done my executive program in finance from IIM Kozhikode. Started my career as an advocate in AP High Court, and then I worked in various corporates like Surana Group, CK Birla Group, Horman Group. So 2018, I joined Welltree Group as a joint promoter and managing director. So before that, my last stint in a corporate as an employee was Horman Group, where I was a CFO there for almost 3 years. Personally, I'm a SEBI registered research analyst. I'm an AMFI registered mutual fund advisor, an IRDA registered insurance planner. I'm trained several MBA students and graduates and employees of several corporates into financial planning, insurance, mutual funds, and fundamental analysis. And we have been associated with Ethica for a very long time, since the beginning of Welltree, and Ethica work life, since the time they have started this initiative, I have been part of this, and I really thank them for starting this wonderful initiative. Yeah. So let's get straight to today's session, what mutual fund is all about. Okay. So as you all know, that mutual fund is actually pooling of money that is collected from various investors for the purpose of investing into securities. Now, when I say this, what actually it means is, when say for example, any of you, whether it is like Mr. Rohit, whether it is Anjuri, Shrikant, or whether it is Miss Babita, any one of you, when you invest into mutual funds, okay, so you all know that, okay, mutual fund sahi hai. Okay, that's the only thing, or most of the thing that people know about ki mutual fund sahi hai. But mutual fund kaise sahi hai? Okay, how the first thing about mutual fund is the entry point, that even with 500 rupees you can start an investment. There is no restriction on the amount of money that you should have or the tenure that you should hold. So say for example, any one of you starting investing into mutual fund. So how that money goes into? Like I part my money of about like 5,000 bucks into a mutual fund scheme. So this money basically goes to the mutual fund company, where they pool this money from various investors. So there will be lakhs and crores of such investors who pool in this 500,000 rupees per month. There are so many people who pool in 1,000 rupees, 5,000 rupees per month. This entire amount is collectively managed and invested by these mutual fund companies into stocks, that is various shares of the various listed companies, bonds, corporate bonds, money market instruments, even the government bond, government instruments. So then finally, once this money is invested, whatever is the return that comes up is again passed on to the investors after deducting the fund management charges, that is of the AMC. Okay. So this is how the entire mutual fund investment goes into, like from investor, the money is pooled, the fund manager manages, he invests into the securities, generates return, and finally the same return is passed back to the investors. So when I say returns, whether it is profit or loss, both are passed on to the investors. So let's see how mutual funds have evolved in India. Okay. So the mutual funds started in 1964, and the first mutual fund The first mutual fund that was started was a public sector, that is Unit Trust of India, UTI, which is currently known as. So till 1987, there was only one mutual fund company that was a public company. In 1987, the government allowed, that is the RBI at that time, RBI allowed public sector banks, LIC and GIC to again start their own mutual funds. So State Bank of India, the SBI mutual fund, was the first public sector, or I would say non-government mutual fund company that was started by India, because UTI was a government company. UTI still is a government company. Then in 1993, it is the time where the mutual fund sector was opened for private companies. So, and the first private company which set up the mutual fund is Franklin Templeton. Earlier it was known as Kothari Pioneer, and which is currently as Franklin Templeton. So at that point of time, it was still regulated by RBI. Then in 1996, this was the liver of mutual funds were handed over to SEBI, and it is from 1996 onwards where the growth of mutual funds started in India. And 1999 to 2000 saw many new mutual fund companies coming in, a lot of public participation into mutual funds. And since 2004 onwards, mutual fund has become a household name. And now, like everyone, like even my own daughter, though I have been doing so many things, but when anyone asks my 11-year-old daughter what your father does, he says he sells mutual fund. Why mutual fund sahi wala? Okay, so that is how mutual fund has become popular. It has become a household name in the last 1 decade. So let's straight get into the business. We have only 1 hour, so I would be slightly going fast. So if by any chance anything is not clear, feel free to ask me to repeat it or clarify it. I would be happy, more than happy to clarify it. So the first thing, so let's look into what are the various jargons, are the terms which you regularly hear whenever anyone speaks about mutual funds. Okay, the first jargon that you use is SIP. So whenever any friend says to invest, he says mutual fund mein SIP kar de. Okay, so many people even feel that SIP is something different, mutual fund is something different. Okay, so SIP is actually a mode of investment. It is a method, a type of method through which you can invest into any kind of mutual fund scheme. So it is a systematic investment plan. So the word itself says it is systematically. So it is actually a reverse of EMI. Like how you, when you take a loan from your bank, the personal loan or housing loan, what happens every month, the bank automatically deducts the EMI, the loan from your bank account, and your loan amount reduces to that extent, your loan and interest amount. SIP is exactly the reverse of the bank, the loan EMI. So SIP is an investment where the mutual fund house will directly deduct the amount which you commit every month. So it can be on a weekly basis, it can be on monthly basis, it can be on a fortnightly basis, very frequency that you can set up. So whatever is, say for example, you have set up a monthly investment. So every month on a specific date, 5th, 10th, 15th, whichever date you specify, exactly on that date, the mutual fund house will debit the money from your bank account and invest it into a mutual fund scheme. Then comes lump sum. So lump sum is, as the word itself says, someone investing a big amount or a large sum of amount at one point of time. So instead of installments like we're on monthly basis, it is like whenever I have money. So SIP is like every month I get my salary on the first week of the month. So let me just save a fixed amount every month. Lump sum is okay. I'm not sure whether I will be able to save every month. So, but whenever I get some savings, whenever I'm having some surplus, or maybe whenever you get some bonus, at that time if someone want to invest, that's a lump sum. Then there are 2 kinds of schemes that you would hear: open-ended and closed-ended. Open-ended means, as the word itself says, which is open. So open for people to subscribe any point of time. There is no restriction. So how much amount you want to invest and whenever you want to invest, it is open for investment. Similarly, closed-ended means where a mutual fund scheme is launched saying that we want to collect 100 crores. So the moment they collect 100 crores, the scheme would be closed. The close for further investment or subscription for that scheme. So that's a closed-ended scheme. Yeah. So then the important term about mutual funds is NAV, that is net asset value. So like I'm not sure how many of you really follow markets or how many of you are aware of like NSE, BSE, how a company's share is quoted. Okay, so in NSE, BSE, a company share is quoted every minute, every second during the day. Okay. Similarly, what happens is in terms of mutual fund, every day and so once in a day, the NAV, that is the net asset value of a mutual fund scheme, is revised, and this is NAV which decides what is the amount of the units that you are holding. So how this NAV is arrived at is, so total asset value. So for example, the mutual fund house where 5,000 crores have been invested. Now this 5,000 crores, when it was invested, was say about 10 rupees was the NAV. Now this 5,000 crores which were invested into various shares and various debt instruments have become today 7,500 crores. So straight away what will happen is this 5,000 at 5,000 crores, when the NAV was 10 rupees, at 7,500 crores where the increase is 50%, the NAV will become 15 rupees. So though it is a very simpler way of demonstrating, of course, there would be deduction of the fund management charges and everything, and then finally the NAV would be set up. Market capitalization. Now, how many of you have heard this term and how many of you have not heard? If you have heard, type heard into the chat box. If you have not heard what market capitalization is, type what it is. I want everyone to start using the chart window. Okay. Not heard what it is. Okay, fine. So, yeah, so I wanted to know this because this is one of the very important term which anyone who is investing into mutual funds or share market should know. So market capitalization means every company or every corporate, when it issues shares to the public, when it comes and get itself listed in NSE, BSE, it issues shares to the public. So say for example, Veltri Group, it has come public, or say, for example, Ethica Worklife. Now, Ethica Worklife tomorrow has come with an IPO to raise say 10 lakhs rupees. So 10 lakh rupees, it is issuing 1 lakh shares of 10 rupees each. So the total capital of the company would be 10 lakhs. That is 1 lakh shares of 10 each. Okay, so 1 lakh shares of 10 each will become 10 lakhs. Now, after listing, this company where the share was listed at 10, issued at 10 rupees, the listing price became 50. So it became 50. So what would be the total value of the company? It will become 1 lakh shares. I'm sorry, I just need to mute my mobile. Yeah. So 1 lakh shares into 15 will become 15 lakhs. Okay. So this 15 lakhs is exactly called as market capital. That is the market capital, market value, or market capitalization of that company. So similarly, it is like number of shares of that company into market value. That determines the market capitalization. So the various companies in India which are listed onto the market, NSE or BSE, are divided based on their market capitalization. They are divided into large cap, that is large capital, mid cap, and small cap. How many of you have heard these terms? Large cap, mid cap, small cap, large, mid, and small cap. Yes. So this is exactly how this large cap. When they say large cap, the first 100 companies, so 1 to 100 companies, are called large cap. Okay, so 1 to 100. So in terms of, so there are about 5,000 plus companies which are listed in stock exchange. So out of these 5,000 companies, based on the market capitalization, the top 100 companies in terms of their market capitalization are called as large cap. Okay, so 101 to 250 is called mid cap. Okay, and then 251 plus are called small cap. Is this clear? So the first 100 companies in terms of market capitalization is called large cap. 101 to 250 is called mid cap, and 251 plus is called small cap. Okay. So these are the companies which are, so the funds in which so when I say large cap fund, that means the fund, majority of the money will go into only the top 100 listed companies of India. Okay. And when I say mid cap, so that mid cap scale fund will invest predominantly into 101 to 250. So these 150 companies. So these 150 companies which fall under mid cap, they would predominantly would be invested into these mid cap companies. And when I say small cap fund, when I say small cap fund, any company which is 251 and below, all these companies will come under small cap. So there's a huge gamut of companies where a small cap fund can invest. Okay. Now there is another term called, because I'm actually telling you market cap, I will tell another term now itself, that is called multi cap. Okay. So multi cap. Now when I say multi cap, okay, any guesses what multi cap can be? Because it is so evident from the name itself, I'm sure most of you would be able to guess it right. So any guesses what multi-cap maybe? Yes, it's a mix of them. Yes, it's a mix of all these companies. Okay, yeah. So then there are two kind of funds you would have heard of: direct mutual funds and regular mutual funds. Okay. Uh, so direct mutual funds are the funds. So it's actually every fund. Say for example, any scheme like Access Blue Chip, you say SEBI's focused equity, just which was mentioned by Mr. Shrikant. Okay, SEBI focused equity. It's a multi-cap fund. So any fund is actually distributed or sold by a AMC through two channels. One is a direct channel. Second is a regular channel. So when direct channel means where, as an investor, you buy this fund directly from the mutual fund company. Regular means where you buy through any intermediary like us, like we are a mutual fund distributor. So in some intermediary like us, so you take a help of us to shortlist a mutual fund scheme, and then you buy a scheme through us. Okay. Now you may ask what is the difference between direct and regular fund in terms of fund composition? There is no difference. Yes, what can be the differences in terms of returns? Returns, the difference may be about 0.5 to 0.75%, primarily because there is a brokerage or a commission would be paid to the intermediary by the mutual fund companies. So this is actually service charge which is paid to the intermediary as a advisory charges. Okay. Now this is what the term. So any other term which so are these terms which the jargons, the so-called jargons of mutual funds very clear? Or anyone has any doubts on this? So I think it's clear. I would move further. Yeah. So then, mutual fund is though mutual fund is a very generic term which is used. The companies which manages this is called asset management company. The official name is asset management company. It's a company which manages the assets. So asset can be anything. It can be shares. It is basically financial assets. So any kind of financial assets. So Babita ji, we will come to that. What is a balance fund? Okay. So my doubt was okay. Up to this is everything clear. Okay. So asset management company is a company that invests its clients' pooled funds into securities that match declared objectives. So as I told you, like the objective, every fund would be having a declared objective. Like a large cap fund would say that it would be investing into large cap. So this asset management company has to invest the funds which have been pulled into that specific securities which fall under the defined objective. Now, what these AMCs do is two things: pooling of funds. So pooling of funds from people, from investors like you and me, and second is managing these assets. So securities in the sense the shares. So any financial instrument basically is called security. So like company shares, corporate bonds. So these are all securities in which companies will invest. Mr. Srikant, beta ratio and all we will be taking up in the next session, not in this session. It's too early to speak about beta ratio because I appreciate you seem to have a fair knowledge about mutual funds, but since we are addressing to a crowd who more or large is still novice in terms of mutual funds. So I would like to cover the basics today and then take up the beta ratio. So beta ratio would be surely taken up in the next session. I will take you all the alpha, gamma, what is the beta, what is the standard deviation, everything about how to study the ratios. We will surely cover up in the next session. Okay. And I'm happy to see you so active and asking this kind of questions. Yeah. So as the list itself, these are the top 10 asset management companies which are there in India. So the first question is why one should invest into mutual funds. Okay. So the fact itself that you all have started attending, you came, took out your time and are attending today's session is that you are all interested to invest in mutual funds. Now, I would like to know what is your reason? Like, why do you think you should invest into mutual fund? Can you all start typing? Whatever comes to your mind. Can you, any one-liner? Like, why do you think you should invest into mutual funds? For your retirement, okay, future savings, good returns, better managing of our money, security, inflation, okay, to beat inflation, good returns, yeah. Systematic investment, yeah, it brings discipline in your approach, yeah, systematic returns, increase value of money, yeah, no doubt because equities is one of the instrument where it can earn the highest amount of money and people who cannot invest directly into the stock market, yes, mutual funds is a very better way, yeah. So see, every person at different point of his life has got various milestones, I would say life milestones, which are capital intensive. Why I say capital intensive? There is a huge amount which a person needs to spend during his lifetime. So it starts with his career, so which is sponsored by parents, then marriage. So marriage, yes, earlier it was like taken for granted that it was sponsored by parents, but nowadays I see a lot of youngsters whom I interact with. They say that one of the financial goal I have is like pull up money for my marriage, and I appreciate really. Oh, somewhere it's syncs with the Atmanirbhar scheme of PM. Yeah. So marriage, then kids, car is there, kids is there, purchase of car, kids. So kids like okay, when it comes to delivery, it becomes very costly. The first 2 3 years, upbringing of kids, it's not a small amount a person has to shell with. Uh, then house, somewhere down the line, everyone's dream is to buy his own house. एक बंगला बने नहीं आ रहा. Your kids education, kids marriage, so all these things, see, so when it comes to financial goals, you have multiple goals with different tenures, okay. So like a person who is in 20, for him, if he wants to plan for his marriage, start with planning for his marriage, maybe he would be planning to marriage somewhere in next 3 to 4 years, okay. So for him, for planning for his marriage would be only 2 to 3 years away, but when it's come to his house, he can think of that within next 10 years I should buy a house, okay. So mutual funds per se give you variety of options. It has a variety of options. People misconceive that mutual fund means investing into stock market. Investing into stock market is one of the asset class where mutual funds invest. In addition to stock market, there are many other asset classes where mutual funds invest, and mutual fund schemes have got various schemes that can suit your goals of different tenures. So if you want to invest money for a 1 day, there is a mutual fund scheme available. If you want to invest money for a 1 month, there is a mutual fund scheme available. If you want to invest for a year, there's a different kind of scheme available. And if you want to save for your longer term, like for, like 10 years goal or 5 years goal or future, like it's about my retirement, there are different types of mutual fund schemes that are available. Okay, so this is one of the reason why one should invest into mutual fund, because he can customize his investments based on his financial objective, financial goal. That is one thing. Second, as I said, there are multiple asset classes to which a person can take exposure to through mutual funds. It can be debts, it can be gold, it can be shares. Okay, even a person can invest into Nasdaq or S&P, that is US based companies. A person can even invest into Google or Facebook through mutual funds. Okay, so there are various options, asset classes that are available under mutual funds. Now, third, why one should look for investing into mutual fund is, as rightly it was said, for higher returns, returns that beat inflation. Yes. See, it is a proven. There is two doubts about it. Though people feel that okay, investing into stock market is risky. Now, how many of you feel investing into shares is risky? Investing into stock market is risky. How many of you feel? How many of you feel? If you feel it is risky, type risky. If you feel it's safe, type safe. How many of you feel investment into stock market is risky? Risky, not sure. Shrikant, quite tricky answer saying safe. Safe provided if we know. Risky with profits. Risky. Okay. Now you tell me when you say risky, what does risk means? What does risk means? Fear of losing money. The fear of losing money, as you yourself said, it's actually a fear. Okay. So risk per se is not about losing money. That is one of the contingent thing that can happen. Risk, I would say, whenever it comes to investment, not just mutual funds or shares, into any damn thing, whatever you do in your life, risk comes in doing something which you don't know. When you don't know, when you are not learned something, when you are not, say for example, if I ask you, like someone who would have who drives a car, okay, just imagine, just go back. When was your first day when you got into a car and held the wheel? Okay, when you didn't know how to drive the car, and if someone has given you a car key and said just go and drive this, okay, what is the most likely thing that will happen? No doubt accident, or is there any other probability? Most probability thing that is accident. That if I don't know how to drive a car and I've just started the car and started driving it, I'm sure I will go and bang someone, okay, or some tree, some put something, but accident. The likelihood of an accident is very high. Now, same thing after I have learned. So when I started learning, initially there would be a lot of hesitation in me. Okay, once I've learned the car, today I can talk over mobile, though it is illegal. Stick, I can talk over mobile and drive without any. Okay, so does that mean there will be no accident? No, the possibility of even meeting with an accident today is still there. Okay, only thing is today, because I know how to drive the car, the probability of meeting with an accident is low, whereas when I didn't know how to drive the car, the probability of me meeting with an accident was very high. Similarly, when it comes to investing into mutual funds or that matter into stock market directly, the probability of you losing your capital, the probability of you losing your money is very high when you invest without knowing about it. Just because your friend has said, just because some Tom, Dick, and Harry has said, if you invest based on others' advice, okay, it will be, the probability of you losing money would be very high. Now, once you have learned, the probability very low. Now, what if I cannot learn or I don't have the time to learn, okay, and still want to invest? So what you do if you don't know what drive a car, what you do? You hire a cab. You hire a driver. You get a driver for you. Okay. Similarly, if you don't know how to invest, you get a financial advisor. So I would say financial advisor is a driver for your investment. So either you drive yourself or you hire a driver. And the best thing would be, I would really like one of the answers where I said, I would love to invest. I think Raju said that. Yeah, though I'm taking help from my friend, I would love to invest on my own. Yes, the best freedom would be like if I can drive my own car, that was the best thing. But yes, the safest thing again, if I don't know how to drive the car, I get a driver. Now let's come to what are the various types of mutual funds. Okay. Now when it comes to asset class, okay, as I said, mutual funds provide an option to invest into various kinds of asset classes. So the first and foremost, which everyone knows, are things mutual funds are is equity, that is investing into the shares of different companies. Okay. Second is debt. So debt means loan. So what happens is when you invest into a debt fund, the money which you have invested is given as a loan to various companies. So the company, based on its credit rating, will again pay the interest. So the higher the credit rating, like if I'm giving money to a AAA company, like highest rated company, some big company which is very financially well-to-do, it will pay me something around 8 to 9% interest. The same if I go and give to a company which is financially not very strong. Okay. Now the strength of the financial strength of a companies are determined by the credit rating. So there are various credit ratings that are given like AAA, AA, A, triple B. So normally AAA is the highest grade, are the safest grade in terms of debt. That is what it is said. Okay. So depending on the various kind of companies, the debt funds are invested. Okay. Now, what are the various kind of debt funds that we will take into detail later? Hybrid. Now, hybrid, as someone asked me, what is balance fund? Balance fund is nothing but hybrid funds. So, hybrid fund means it's a mixture of both equity and a debt. Okay, a hybrid fund is mixture of both equity and a debt. So, it will have a part equity and part debt composition. So, that is a hybrid fund. Debt is risk free. There is nothing called risk free. Investment is all about risk. It is all about low risk or high risk. Okay. So, Damospita, please be very clear. There is no investment which is risk free. Even the money which you are putting, saving into bank is also, there is some amount of risk involved. Okay. The only thing is in investments, you always get used to a terminology called low risk and high risk. Okay. So debts are relatively lower risk, equity is relatively higher risk. Even debt, there can be certain high risk funds like credit risk fund. The word itself says credit risk. There are again high risk funds where the money is invested into low quality companies, low financial quality companies, so that you get higher return, because when a company's financial quality is low, it will pay you a higher interest. Okay. So hybrid, then gold. There are gold ETFs. Yes, you need not buy gold physically. If you want to invest into gold, if someone has a fancy to invest into gold, the best thing today I would suggest is, instead of going and purchasing a jewelry which you are not sure whether you will wear it or not, because nowadays there is a lot of liking has gone to artificial jewelry, a variety of jewelries. Okay, so if you don't want to buy jewelry which you are sure you are not be using it so often, or instead of going and buying a physical gold and keeping it at home by taking risk, one of the best method is invest into gold ETFs. So you can start even investing about like 100 rupees. You can buy gold at 100 rupees, so gold ETF. So 100, you can still accumulate a lot of money. Finally, that amount is invested into gold. And the day when you want to buy a physical gold, you can sell these units of gold ETF, withdraw the money, go and buy the physical gold. Okay. Then fund of funds. Fund of funds, as the word itself says, it's a fund which invests into other funds. So basically, when I want to take a foreign exposure, many of the foreign exposure, uh, when someone want to take a foreign exposure, uh, there would be, the mutual fund would be investing into various other mutual funds which are listed there into that other company or other market. So these are the fund of funds. So fund of funds invest into different other funds, maybe the domestic funds, or it can be international funds, or it can be even a mixture of different other asset classes, which is called fund of funds. Fernandez, I'm not sure about which gold IPO you're talking about. Okay. Yeah. So this is the types of funds in terms of asset class. In terms of management of funds, the way funds are managed, it can be categorized into two, that is actively traded and passively traded. Passively traded means that is ETF. That is, so when it is an when it says actively traded in the sense, what will happen is, first thing is, the fund manager will be actively involved into managing funds. Okay. Now, when it comes to ETF, what will happen is the fund manager will not actively involve. That is, he will not determine which company shares to invest, when to sell, when to buy. What he will do is, he will try to replicate a index, okay, or he will just replicate an asset. So, say for example, let's continue talking about gold ETF as Indranal is asking. Okay, gold ETF. So, if someone is investing into gold ETF, what will happen is the moment you invest 1,000 rupees, the fund manager will go and 1,000 rupees gold at whatever is the market price. He will just buy and sit down. So he will not actively manage. He will just keep on buying and adding. Whenever you want to sell, whatever is our market price, at that price you will get your money. Okay, so that is what. Now, when it comes to commission at buying and selling for gold ETF, it is very negligible in the name, very negligible, because even when you go and buy a gold from shops, the commission that you would be paying to the shop fellow would be much more higher than the commission or operation expenditure which would be incurred in the gold ETF. Highly negligible. Okay. Now, Devasmita, is balance fund the best instrument to invest? There is nothing called best instrument to invest. Uh, every instrument has got its own pros and cons. It is all about which one suits you, suits your requirement. Okay, and that is what we will try to cover, that how you should understand which fund you should go for based on your requirement. I will be covering that also. Okay, Shin, gold bonds was a different thing that was issued by the government, where when you purchase the bond, like instead of ETF, what happens is the market price. So in that, government would buy the bonds. So like when you buy a gold bond, government will you will be buying the gold at the same time. There is, I think, 4% interest rate which would be given into you. So on the one side you will get a market price. At the same time, government will give you the interest, because there are two things now. The basic difference between gold ETF and gold bonds is, gold ETF you can go and buy even for 100 rupees, even for 50 rupees. Okay, gold bonds, there is a fixed minimum entry, minimum 10,000, 1 lakh, there is a fixed amount. Then you cannot sell the gold bonds whenever you want. When it can be sold only whenever the maturity date comes. Gold ETF you can sell every day. Like today I can buy, tomorrow I can sell. So this is in detail. Now this one slide will tell you that what are the various type of funds which are there under various categories. Okay. Now let's come to equity. Let's focus first on equity. Now equity, already I said there's a large cap fund, mid cap fund, small cap, multi cap. Okay. So these four I have already clarified. If anyone has any doubts into this four, please ask me. Okay. So large cap fund basically invest into top 100 companies. Mid cap funds basically invest into 101 to 250 companies. Okay. Small cap funds can invest into 250 below, and multi-cap fund means it can invest into any of these funds. It can invest into large cap, it can invest into mid cap, it can invest into small cap. There is no specific restriction. Okay, but basically most of the multi-cap funds are like focus funds, where they invest into only 25 or 50 companies. Okay. Sectoral funds. ELSS is a different class, Rohit. It can be termed as a multi-cap, but it is not multi-cap. ELSS comes with, it's basically for tax saving. So if you want to buy a fund for tax saving purpose, ELSS funds are there. Okay, basically for your ATC deduction. Okay, so for ATC, when you buy a fund, your tax saving, this ELSS would be there. And the major difference between your regular equity fund and your ELSS fund would be that ELSS funds comes with a lock-in of 3 years. That is from the date of every investment. Say, for example, you have done an SIP. So the January 2020 that you have invested, it would be under lock-in till January 2023. February amount which you have invested, it will be lock-in for February 2023. So ELSS are basically for lock-in for 3 years. So for 3 years, you cannot withdraw your money at any cost. Okay, so that is a basic. So yes, it can be termed as a multi-cap fund. Sectoral funds are funds which are basically invest into a particular theme or a sector, like banking and financial services fund. So banking and financial services fund will predominantly invest only into banking, or as a consumer index fund, or pharma funds. So pharma funds will invest only into companies which are related to pharma industry or ancillary, like APO manufacturing companies and all. So these are sectoral funds. So they are thematic funds basically. So someone who is very strong, like nowadays people are very optimistic about pharma companies, saying that pharma companies are going to do very well into the next 4 or 5 years. So if you are a person who believes in I want to invest predominantly into pharma, you can go and invest into pharma fund. So these are the sectoral funds. Now, in terms of risk, in terms though equity as a category is a one of a high risk investment. Within this equity, okay, large cap is the lowest risk, okay, and your small cap has a highest risk. Multi cap, I would say moderate risk because it balances it with all the things, and sectoral funds again will have a very high risk, higher risk than even small cap. Okay. So in terms of risk, so based on your list, so if someone who is investing very new into equity funds, we basically advise them to invest into large cap first. Start investing into large cap, get an exposure into equity, get a taste of it. Once you like it, then you can start taking higher exposure by investing into mid and small cap and multi cap funds. Okay. Now, when it comes to balance fund, uh, balance funds are again a mixture of both equity and debt. So whether it is a good or not, I will just come to that part later. Now, second is debt. Debt, as the word itself says, it is a debt, that is loan. So debt funds, there are four kind of funds. First one is liquid funds. So liquid funds are like, as the word itself says, it is very liquid. Like a person can invest money for even a single day. So say for example, you have got some bonus, okay, of ₹1,00,000 today, and you have a plan to buy something from that maybe after a month or two. So instead of blocking that money in your savings account, which will give you about 3.5% return, you can invest into a liquid fund, which will give you about 5 to 5.5% return minimum. And it is very low risk liquid fund, because liquid fund basically invests into government bonds and treasury bonds, which are yeah. Now, ultra short term is funds which invest into instruments with which have a maturity period of less than a year. Okay, so they invest into government bonds which will mature in a year. They will invest into commercial papers of various corporates which will get matured within a year. So where a person want to invest for say about 30 days or 2 months or 6 months, ultra short term fund are very good. This thing. Then short and mid term fund. Short and mid term funds are someone who want to invest, for example, 6 months to about 2 years. So someone who wants to invest for the next 1 year or 2 years. So like say I'm planning. I'm actually saving for my down payment for my house. I want to buy a house, and I'm saving the amount for my down payment. So one thing is that okay, I'm sure that it will take at least 6 months for me to shortlist a house, but I'm not sure when I would require. I may require in a year, I may require in a two, or I may require in just 6 months. So in that case, normally we advise to invest into a short-term fund where you can get a return of almost like 6 to 8%, and still you are free, and because the risk is also low, because most of the instruments in which these funds are invested would be where the maturity period would be 1.5 to 2 years. Okay. Then comes long term. So long term is basically in debt. What we say long term is when you want to invest somewhere between 2 years, 3 years, or maybe 3, 4 years. Okay, that is long term. So long term fund are slightly riskier when compared to liquid and short term funds. So long term funds, again you have to look into that what is the quality of the fund which you invest. Okay, one way of looking at the quality of fund is try to see the what is the fund composition, like in which kind of companies the fund is investing, whether it is investing into like AAA or AA rated companies, or it is invested into funds which are like triple B or A minus unrated companies. Okay. And then comes hybrid. Now, hybrid, equity plus debt, that is where there's a mixture of both equity as well as debt, the so-called, which is popularly known as balance fund. Now, when it says balance fund, there are three kind of again categories. Aggressive funds, aggressive where about like so almost 60 to 70% would be invested into equity, and about 30% would be invested into debt. Okay. Moderate fund where the composition would be 50% debt, 50% equity, and conservative funds would be where almost 60 to 70. It's exactly reverse of aggressive fund where 60 to 70% would be invested into debt, and only about 30 to 40% would be invested into equity. Okay, so depending on your risk appetite, you can invest into whether it is conservative fund or aggressive fund. Okay, now whether balance fund are good, equity fund are good, or debt fund are good. Okay, all funds are good. I personally not I'm not a big fan of balance fund, frankly, what I feel is invest instead of investing into a balance fund. What you can do is you can invest. Say for example, you want to invest into balance fund. Now, what a balance fund will do, if you are investing into an aggressive fund, 65% or 70% it will invest into equity, and 30 or 40% it will invest into debt. Same thing, what I can do, if I want to invest 10,000 per month, I can invest 6,000 into a large cap fund and 4,000 into a debt fund. So this is how I create my own balance fund. So I can balance my own fund rather than depending on someone else whims and fancies to balance my fund. Okay. So that is why personally I am not a big fan of balance fund. Though, as many of you said, most of the advisors are now aggressively promoting balance fund because it is very easy to sell balance fund nowadays. So one peculiar thing about our advisors is we don't advise what would be best suited to you in the current scenario. Most of my advisor friends, what they basically focus is what can be very easy to sell. Okay, so in which it would be very easy to sell and where convincing the client would be very difficult. So because the market has crashed down, if I come and say you invest into equity fund, it will be very difficult for me to convince you. So it is very easy for me to say balance fund में डालो. Okay. Now there are a lot of questions which are being posted into the chat window. I would be addressing that during the Q&A. So I would request you to kindly remember these questions and repost to me during the Q&A sessions. Okay. Now modes of investment, as I already discussed, that there are two ways of investing. One is SIP and lump sum. Now which one is better depends on person to person. But for a salaried class employee, I basically feel, not only salaried class, basically for any person, I feel a person should go for a mix of both SIP as well as lump sum. SIP because it brings in discipline, so it is not dependent on your moods or your every month expense management whether you be investing. So without your own involvement, the funds will get deducted from your monthly income on a fixed date. And what happens is psychologically also after a certain time, a person start planning that okay, मेरा 10,000 का SIP है, I have an SIP of 10,000. He will start planning even 10,000 as his expenditure. So it will not see, the mind will not say whether that it's an optional whether I should invest or not. It will take it as a compulsion, and that brings in a disciplined approach. So many people I've seen they accumulating huge amount of money by just doing SIPs consistently, which had they not done these SIPs and have left saying that okay, whenever I have money, whenever I want to invest, I will invest, would have never happened. Because one of my personal thing which I always feel, which I even told in the previous session, people who attended the previous session would have seen that the best way of managing your monthly income is that income minus savings is equal to expenditure. Okay, so out of your income, you should decide what should be your savings. You should minus your savings, and then with the balance amount, you should see how you can meet your expenditure rather than after meeting all your expenditure to see what would be the balance amount which I should save. Okay. Now lump sum, what happens is there are two ways to invest into lump sum. One is whenever you get a big amount like your monthly, your annual income or maybe quarterly incentive, okay, or maybe your salary areas, when you get a huge chunk of amount, instead of investing that entire chunk into buying some capital asset like I want to buy an iPhone, I want to buy something for my daughter or some XYZ for my wife, instead of doing that, what you can do is out of say if you've got a bonus of lakh, you can invest like 40-50% into a lump sum SIP, lump sum mutual fund, invest lump sum, and balance you can go for your expenditure. Okay. Another way for lump sum is whenever market falls. Like when you see, like when there was a market crash because of the lockdown, okay, that was the best time to invest your lump sum amount into the mutual fund rather than worrying if my existing mutual funds have eroded. The best way would have been put a lump sum amount if you have some surplus money, put that so that when the market bounces back, you get multi times returns rather than just 5-10% or 15% return. Okay. There is a brief comparison of like how SIP and lump sum investment would look like. That how a rupee cost averaging works. Okay. Because of the paucity of the time, I would not take much onto this. Okay. Why SAP? I've already discussed this. Now, which fund suits me? Okay. Now, which fund suits me? So, which fund suits me? These are the four parameters which you should always ask yourself before even deciding which fund you should invest. Okay. So first thing is your time horizon. That what for how much time I want to invest, because the time horizon will decide your risk taking ability are the kind of funds which are suited for your investment. As I told you, there are funds for 1 day, there are some funds for 30 days, there are funds for 1 year, there are funds for even 10 years. Okay. Now, second comes risk appetite. Now, risk appetite you should be aware of. Now, when it comes to risk appetite, basically the risk appetite is measured in two ways. One thing is, first, if I know what mutual funds are, what kind of funds are, and what is the various composition of things, okay, that knowledge itself will increase my risk appetite, because I know what kind of funds are, what is the benefits, and what are the pros and cons of this various fund. That itself increase my risk appetite. I can know how much to invest into it. Okay, first thing. Second thing is, when you're investing into shares. Now, how many of you recall there is a mutual fund ad which is very popular, in which Sachin Tendulkar comes? That when he asked one of the boy to go and start facing a fast bowler, and his mother comes and say, do you think it's too early for him to go and face? It's too risky. And then Sachin asks that mother that, do you invest into mutual funds? So isn't it risky? And then she says, if you cannot take the risk, then you should not even invest into mutual funds. Okay, how many of you recall this ad? It's very popular. It's comes quite often nowadays. Okay, so same thing. So if you can't take risk, okay, then better go and don't dream of saying I want high returns. Okay, don't dream of saying I can't. Yes, always take a calculated risk. Okay, always take a calculated risk. Take a risk based on your time horizon, based on your own understanding. Okay. Third thing is expected return. Yes. So if I want to invest into a say liquid fund and I want a return of 10%, it's impossible. So if I want to see if I'm happy with a return of 10%, then somewhere either I can invest into a long-term debt fund, I can invest into balance fund, I can invest partly into a debt fund and partly into a large cap fund. Okay, and I can balance this and get a return of 10%. So at the end of the day, your fund composition, which so basically when we design a client's portfolio, what we do is do the balancing of all these things and then decide that how much should go into a large cap, how much should go into mid cap, how much should go into a small cap or multi cap, how much part of it should go into a debt fund. Okay, so it is not like one fund or one type of composition suits all. No, the fund composition should be customized to a person's requirement, because time horizon, risk appetite, expected return is all unique to a person. It is different from one person to another. Even two friends will not have the same kind of financial goals, will not have the same kind of risk appetite. Do you agree or not with this? That no matter whether you are investing into the same funds, your time horizon, your risk appetite, expected return would be different. And to add this, even the probability of early withdrawal. Now, someone who's already having some other sources of incomes, or he is from a well-to-do family, okay, his probability of withdrawing funds in case of emergency would be very low. And the same thing, if you are the earning member of your family, your entire expenditure, everything, whether planned, unplanned, everything is dependent on your own income. Okay, and suddenly some unplanned huge expenditure comes. What will happen? You will go and dig into a mutual fund. You will have to withdraw it, isn't it? So your probability of early withdrawal also. We have seen many of our clients says, "This is for my daughter. Okay, so I'm ready to take as much risk as possible. I want highest return, and I'm sure I will not withdraw it for the next 10 to 15 years. Okay, but I've seen they coming suddenly saying that someone has fallen ill, so need further hospitalization or the needs further expenditure. Okay, withdrawing it. Okay. I've seen that. Okay, so probability of early withdrawal. So this is also one factor which we try to incorporate it while designing a funds portfolio. Now, this slide, I would suggest everyone to please take a screenshot of it. Okay. There is one actually mistake into this slide. There is one error. Just a minute. Yeah. Yeah. So now I request everyone to, you can actually take the screenshot of this slide. Okay. Uh, so this is basically, I've tried to give a composition and a guidance based on all the factors. That is, what will be a tenure. So based on your tenure, your risk category, and also expected returns, how you can choose. Now, when you're choosing funds, okay, the first thing that I would always recommend is never put all your money into a single kind of fund. So just because say I'm investing for more than 10 years, I can take as much risk as possible. So I will go and invest all my money into small cap. No. Okay. So basically what we try to do is I divide people into conservative, moderate, and aggressive. Okay. So you decide how you call yourself. Okay. Now conservative means people who are more concerned about their capital. That is, if I'm investing a lakh, my lakh should stay as a lakh. It should not get reduced, no matter if I get even the return somewhere around my fixed deposit. That is like 7 to 8% or 6% return is also fine, but my money should not get eroded. Okay. So for this kind of clients, that is conservative clients, what we normally recommend is basically 50 to 60% should get invested into long-term debt fund for the long term. So I'm telling is for the long term plan, not for a short term. Short term already I've given. So 60% should go into a long term debt fund, and 40% they can invest into a large cap fund. Okay, so that is for a conservative investor. Now, if you're a moderate investor, saying that boss, I want a slightly higher return, I'm ready to take slightly higher risk, but not like something which can just open my pants. Somewhere my capital can get completely eroded. Okay, I don't want to get into that kind of things. Okay, fine, go for a moderate risk. So for them, what we do is the fund composition that we basically suggest is you can go for like 30% large cap fund, 30% multi-cap fund, okay, and then about 10% into a mid-cap or a small cap, and 20% into a long-term debt. Okay, we don't so for a moderate, we normally we don't normally recommend them to invest into a small cap unless he is really ready. And then for aggressive, what we suggest is you should not invest more than 50% of your entire money into mid and small cap. So your mid and small cap exposure should be 50 or less than 50, and then balance you can go for a large cap. So this is what we basically recommend. Okay, so this is again one slide which you can just take it up. It is self-explanatory that people who are risk takers and risk avoiders, where for short-term goal and long-term goal, where you can invest. So a composition of this and this would can help you on first the kind of funds that you can select. Okay, someone was asking me blue chip fund. Now, blue chip fund is actually name of a fund. Now you have to see what is the category of that fund. Okay, like Access Blue Chip Fund is a large cap fund. Mira said Emerging Blue Chip Fund is a large and mid cap fund. Okay, so look at what is the fund category, not the fund name. Okay, now SEBI has restricted giving a lot of fancy names. It has become very easy for people to so always look at the category. Okay, now fund selection criteria we will take up in detail the next session. Okay, so next session we can plan on how to shortlist a debt fund or how to shortlist a equity fund. So basically, how to select a fund, like what are the ratios, what are the alpha, what is the beta, that will be taking up into the next session. These are the websites where you can go for references. That is moneycontrol.com, your valueresearchonline.com, and morningstar.com. These are the three websites where you can get a lot of data onto mutual funds, and you can get all the details about any of the mutual funds. Yes.
Yeah. Thank you so much, Rajesh. I think a lot of questions Rajesh answered during the session. But if you have any more, you can quickly use your chat bot to start putting in your questions, because we have 10 minutes to go before we close this.
Okay, Mr. Balasubramaniam just sent a thing on my personal private. Yeah, he has put it a private chat. Now, I would recommend everyone to please put it for everyone so that everyone sees the question that has been put to me. Okay, so his question is short-term period investment, that is 1 or 2 years, 4 to 5 lakhs fund, which is a good option. Okay. Now, Mr. Balkrishnan, now I would like you only to answer your own. So now you tell me, looking at this, which one you would like to invest? Like for 1 or 2 years, 4 to 5 lakhs. Where should you invest? Yes. He's again replying to me privately. Yeah, Mr.
You
He has
can, Mr.
replied saying
Balasubramanian, you can
long-term
unmute
debt fund.
yourself and answer. Mr. Balasubramanian, you can unmute yourself and answer to that.
Long-term debit, sir.
Yeah, so long-term debt fund would be a better fund instead of like, but in the current scenario, because of the COVID times where there is a lot of concern on the financial stability of companies. Okay, so if it is only for 1 to 2 years, I would personally suggest you to go for a short-term debt fund rather than going for a long-term debt fund. Go for a short-term debt fund.
Okay, all right. There's a question from Vishal. He's saying, what is Financial Hi-Fi Group as per your slide?
Yes. Yes, Amina, would you like to take it up, or you want me to?
Yeah, please go ahead and answer this.
Yeah.
What is Financial Hi-Fi Group as per your slide is what he wants to know, Rajesh. Please address it.
So, see, the Financial Hi-Fi Club is actually an initiative taken by Ethica Work Life. So they have got various clubs which are shared to your HR, and through your HR, these links are circulated to everyone.
Yeah.
So based on your interest, like there is a yoga group, there is a meditation group. So similarly, there is a Financial Hi-Fi Club where any of your queries related to personal finance can be addressed, and the queries would be addressed personally by me. So I'm part of this group. I moderate this group. Okay. So any of your queries, any doubts, any if you are part related to your personal finance.
Right.
Okay,
So, yeah, Vishal, I would
Thank
just
you.
elaborate this a bit. And this is for everyone to know, actually. You all know that we are conducting all these kinds of wellness program and also this financial program. So between the sessions, I mean, before the next session happens, if you have any further questions or you have any queries that you want to revisit us with, then we have created these hi-fi groups, which are WhatsApp groups for each domain. Finance also, we have a finance group. Here you can subscribe, and Rajesh will be leading the group. So any questions you have, he can address them the same day probably. And then before the next session comes, you'll already have a lot of your questions addressed. So you don't have to wait till the next event happens. So that's the idea. I will request my colleague Arshia to put in a link here to join the WhatsApp, this Financial Hi-Fi WhatsApp group. Arshia, please put in the link for that here. So all of you can join this group and you can have all your questions addressed through this platform, right? Okay, let's move on to the next question, Rajesh. It's from Vijay. He says, for stocks, we receive dividends. In case of mutual funds as well, do we receive it? In case of mutual funds also,
yes,
do we receive
yes,
dividends?
Vijay, when it comes to mutual funds, there is two options. Whenever you invest, you can opt either for dividend or growth fund or growth option. It is not a funds, but it is an option. So dividend and growth, what happens is whenever the funds gives you good return, the fund can declare a dividend and dividend would be paid to you. That is one thing. Second is whenever the fund gives good return, it is again reinvested. Okay, so basically for long-term investor, we always suggest to go for a growth option rather than dividend option, because dividend again it is highly taxable. There's a tax deduction of almost 24 to 25% that happens, and again that is dividend which you receive from mutual funds is again taxable. Of course, though dividend beyond 1 lakh is taxable in your hand, so I don't think that would be the amount of dividend would be receiving in the current near future. But yes, for a long-term investment, we always recommend to go for a growth option. Dividend option is for people, for like retired people who want to invest and they are dependent on the monthly income. Even for retired, like many of our retired clients also, we don't advise them to invest into dividend funds. What we recommend them is, if you are dependent on your monthly income for your out of the amount which you are saving, please put into a liquid funds, withdraw from the liquid fund and let your fund grow. And whenever your fund has grown, then again withdraw, put it into a liquid fund, and again then start withdrawing from that. Okay. So dividend option is available, but personally I suggest not to opt for the dividend option. Okay. There is another question from Shrikant, that is 10,000 monthly SIP moderate risk fund selection, term insurance with SIP details. Shrikant, I have not got your question, but I think what you are asking is if you want to invest 10,000 into an SIP with moderate risk, what should be the fund selection? Okay, which are the funds that you should invest? Isn't it? Is that the question which you are asking, Shrikant? But in between the term insurance thing, somewhere I'm not able to understand.
Yeah, you can unmute yourself and ask that because we're not able to understand it.
Yeah. Sujani Chundari is asking, I invested for a period of 15 years. When I get amount, is it taxable? See, Sujani, the mutual funds about 2 years back, they were not taxable, long-term gain. Okay. 2 years back, long-term capital gain tax have been started. Okay. So till 2018, whatever your fund value was, okay, that would not be taxable. Whatever has grown beyond this 2018, okay, whatever has grown beyond 2018 would be taxable at the rate of 10%. Okay. So say for example, in 2018, your fund grown to 5 lakhs and now this 5 lakhs has become 7 lakhs. Okay. I'm not speaking about the fresh investment that you have made in the last 2 years. As on 2018, what was 5 lakhs has become 7 lakhs. Your taxability would be on the balance 2 lakhs. So it is a 7 minus 5 on 2 lakhs at the rate of 10%. Okay.
There is a question from Suren which we have missed out, Rajesh. He is asking how to withdraw money from mutual fund when needed. Any hidden rules there?
No, see, if you are directly investing into this thing, you will get a direct option where you can click onto the app or you can go to the online site and withdraw. You will get basically, depending on the kind of funds, max it is T plus 2, that is transaction plus 2 days. So if you are given a withdrawal request today, within 2 days or max 3 days, 3 working days, 3 days means working day. The third working day, you will get the amount credited directly to your bank account.
Oh, any lock-in periods?
Lock-in period, as I told you, is only for equity-linked savings scheme. That is for tax saving. Only ELSS funds have got a lock-in. Other than that, there is no lock-in period. Yes, there is an exit load in few of the schemes, like in terms of equity funds and all. There can be an exit load of 1% in the first 365 days. Say, for example, you have invested today. Within a year, if you are withdrawing, there will be an exit load of 1%. Okay, but after a year, there is no exit load.
Okay, can we do SIP without ECS?
No, SIP without ECS is not possible. Then you will have to keep investing every month whenever you want. Okay. SIP is ECS is mandatory. ECS is mandatory.
Yeah. Thank you.
Thank you, Suren. Okay, there's a question from Anjuri Srikanth. Srikanth, it's a little difficult to understand your question. He says 10K monthly SIP moderate risk fund selection, term insurance with SIP details. Now, what do you intend to ask here? Can you unmute yourself and ask this question, please? Anjuri Srikanth.
Yeah, those two were separate questions. With SIP, we get term insurance also, right? 100 times?
No. For with SIP, you don't get any insurance. That is your ULIPs. Okay. SIP is into mutual fund. There is another thing called ULIP. So ULIP is again a kind of mutual fund which is managed by insurance companies. Okay. So in that you get an insurance cover of 10 times, not 100 times. It is 10 times. Okay. And basically ULIPs are managed by insurance companies. Your so-called SIP or which you popular, they are managed by the mutual fund companies. Now, one thing which most of the people don't know, or most of the insurance advisors don't tell you when you are investing into ULIP, they say, sir, you are getting 10 times insurance cover in addition to your investment. Sorry, it is not in addition to your investment. Whatever your insurance cover that you are getting, that premium with respect to that insurance, okay, is deducted from your investment. So say for example, you are investing a lakh into a ULIP fund. Okay, there is a mortality charges. That is, say for example, your insurance cover would be some 2,000 rupees or 3,000 rupees. The 3,000 would be deducted and only 97,000 would be invested. Then there would be fund management charges. Okay, premium allocation charges, which is called PAC. So there will be premium allocation charges of 5 to 10%. So basically, the amount is, if you are investing a lakh, only something around 90 to 92,000 is invested. Rest 80,000 is deducted in terms of expenditure and insurance premium and all. So your insurance cover is not free; it is charged. Okay. Instead of that, the best thing would be go for a pure term insurance and invest amount into mutual funds.
Okay. Let's move
Minimum
on.
amount to start SIP, Suren, minimum amount can be as low as 500 rupees. Okay, with 500 rupees per month also you can start an SIP.
Oh, thank you.
Can we move to the next question, Rajesh, very quickly?
Yeah, ULIPs versus ELS is the same. See, ELS I've already explained. ELS is a type of fund which is managed by the mutual funds, which is for tax saving. So for your ATC benefit, so whoever want to go for your ATC benefit, ELS is one of the best option where you can invest. But ELS comes with a lock-in period of 3 years from the date of every investment. Okay, and ULIPs are again not mutual funds; they are different. They are actually a insurance, a type of insurance policy where the exposure is into equities. Okay.
Right. There's one question from Sheikh Basha. I think a lot of people will have this question. He's asking, is this the right time to invest as it's a pandemic now? The reason is the market unstable?
Yeah, Sheikh Basha, first thing is, yes, is it the right time to invest in pandemic? Yes, whenever, see, Warren Buffett. How many of you have heard about Warren Buffett? How many of you have heard about Warren Buffett? Is there anyone who have not heard Warren Buffett? Yeah. One, Warren Buffett is actually the father of value investment, father of investing, and he is the richest investor in the world, and he is into the top 3 wealthiest person on this planet currently. Okay, so one of the thing which Warren Buffett says is, okay, you can note it down if you want. Okay, be greedy when others are fearful. That is, be greedy when others are fearful, and be fearful when others are greedy. So in current pandemic scenario, when others are fearful, it is a time where you become greedy. That is, you enter into the market, become greedy to earn from the market. And when the market is running, booming like anything, when others are greedy, that's a time to move out of the market. That is, redeem all your investments. So yes, Mr. Basha, this is the right time to invest into the mutual funds, okay, or share market or whatever it is. Yes, but the next 6 months are going to be highly volatile. Volatile in the sense there would be a lot of ups and downs into the stock market for the next 6 months. So what we suggest our clients is, what you do is invest. So for example, if you want to invest 5 lakhs, what you do is invest this entire 5 lakhs into a liquid fund, and from there you do a systematic transfer plan. That is, systematically you transfer every week, okay, an X amount for the next 25 weeks. Okay, so that like 20,000 every week you keep transferring to the various funds. So like 4 funds, 5 funds which you want to opt for, keep transferring into these 4 or 5 funds every week. 20,000 is for the next 25 weeks, so that your investment will be spread throughout the next 6 months. So whether market falls, goes up, whatever it is, you can average it out and take a benefit of it. Okay, so first thing. Second thing is, if you are investing today, you should invest only that amount of money which you are very sure you will not require for the next 5 years. Okay, so if you are very clear that I will not require this funds for the next 5 years, only then enter, else please stay away. Third thing is, if you are investing today, be prepared to, at some point of time, to see your investment erode by even 30 to 40%. Okay, like if you are investing 5 lakhs, be prepared to even lose 1 to 1.5 lakhs in the short term. Okay, don't get panicked just because it is 3.5. You should stay patient. You know you have invested for 5 years, please wait for 5 years. One of the worst thing which many of the people who invest into mutual funds is, they say it is for a long term, but the moment the next year becomes negative, they get panic and say, I want to withdraw, I want to stop. No. In short term, markets are always volatile. Okay, risk is different, volatile is different. Markets are volatile, not risky. Short term markets are always volatile, and if you don't have the heart or courage to see your investment going negative, then you should stay away from equity markets. Yeah.
All right, let's move to the next question very quickly, Rajesh. What is the minimum amount to start SIP is a question.
I've already answered.
Answer. Okay, wonderful. So I think then let's go to the last set of questions here. Another 2 questions.
Is better to okay, Vijay, is better to invest international funds or domestic funds?
Yeah.
Because everyone in the world is coming and investing into India. Okay, first thing. So investment, see, when it comes to, see, when you are, Vijay, I appreciate you are thinking as a global investor, not a domestic investor. So I would really appreciate for that question first. Okay, so any global investor, what it goes and sees is, what are the various economies which can really grow in the next 5 to 10 years? Okay. Now, the question that I would like to ask you, Vijay, do you see Indian economy growing really well in the next 5 to 10 years? If the answer is yes, you should invest into domestic funds. If the answer is no, if you feel India may go down, then you should look at international funds which can invest into an economy which you expect to grow. That is first thing. Second thing is, yes, people who are interested into taking international exposure, yes, I recommend them to go for NASDAQ 100 ETF.